In this video, we're going to discuss the different tax implications of a corporate redemption versus a corporate dividend distribution. So in each case, whether it's a redemption or a dividend, ultimately what the corporation is doing is it's distributing some funds to a shareholder or shareholders, right? So the difference between a dividend and a redemption is that with a redemption, the shareholder is actually giving some of the stock back to the corporation, right? So let's say that a corporation repurchases some of its stock. There's going to be two potential outcomes for the shareholder or shareholders. So one thing that could happen is it could be treated as a sale or exchange. So when this shareholder accepts cash or property or whatever and then gives stock back to the corporation, it's treated as if they had sold the stock to the corporation. That's important because it's going to get its basis is going to offset the amount realized, right? So you're going to have an amount realized minus the adjusted basis, and that's going to be the taxable gain, right? So or loss you might even have. However, if it's just treated as a distribution per Section 301, assuming that the corporation has sufficient EMP, their earnings and profits, then it's just going to be treated as a dividend, and you're not going to get the basis, whatever the adjusted basis in the stock, it's not going to offset or reduce the amount of any gain. And clearly, you're not going to be able to have a loss either. So this is a little abstract. Let me give you an example to make it a little bit easier to understand. So let's say that you start your own corporation. You start a social media website. So you incorporate this as Bookface. So Bookface is your social media website that you've incorporated. You own all 100 shares of stock of Bookface. So you own 100% of Bookface, right? You own all of the shares. And your basis in those shares is $1,000. And let's just assume as well that Bookface has a lot of EMP, of earnings and profits, of $500,000. So now we've got the facts. Let's pretend that Bookface says, okay, look, we're going to give you $300. So Bookface is going to give you $300 cash, right? And then you're going to give Bookface 20 of your shares, right? So this is a redemption. We've got a redemption here. But now the question is this going to get sale or exchange treatment? And what we mean by sale or exchange is let's look at this here. You're receiving $300 cash, right? So if this is treated as you selling the stock back to Bookface, then what would happen is we'd say, okay, to calculate your gain or loss, we take your amount realized, which is $300, minus your adjusted basis. What's your adjusted basis? Well, you're only getting rid of 20 shares, so that's 20 out of 100 times this 1,000. So that's $200 would be your basis. So your adjusted basis would be $200. So because we're not taking the whole 1,000 because you're only getting rid of 20 of your shares, right? So your taxable, you'd have a gain here of $100 if you got sale or exchange treatment, okay? So if you had sale or exchange treatment, then this would count. You'd have a taxable gain of $100. Now, if this does not qualify for sale or exchange treatment, then we're going to have where we have to look to the rules of Section 301 of the U.S. Tax Code, right? And Section 301 says first, look to whether there's EMP, and to the extent that there's EMP, the distribution is going to be deemed a dividend, right? So we have $500,000 of EMP, and this is a $300 distribution. So under Section 301, this would be a $300 dividend, right? Now, if they didn't have any EMP at all, then we would go to Part 2 of Section 301, where you say, okay, well, now we reduce the shareholder's basis. So if there was no EMP at all, it would reduce the shareholder's basis in the stock. And then any amount thereafter would be a gain on a sale or exchange. But let's just assume here that there's plenty of EMP. So basically it comes down to whether there's going to be a $300 dividend to the shareholder, right? In which case they're being taxed on $300 of dividend income, or whether they're just going to have a $100 gain. Now, if they have this $100 gain also, this adjusted basis is going to offset. Now their stock basis would be $800. So you see from the shareholder's perspective, they would really like to get sale or exchange treatment if this is an individual, right? And this is an individual. So we're talking about you, We're not talking about a corporation, because a corporation is going to be slightly different. So you, an individual, would prefer to get the sale or exchange treatment. And that's because you can offset and reduce any gain that you have with your basis in the stock. And potentially even there might even be a loss, right? You would rather that, so now $100 a gain instead of $300 of dividend income. So that's why individuals will prefer that they really want to get the sale or exchange treatment. Now, whether or not this transaction will get a sale or exchange treatment, we're going to talk about in the rules under Section 302B. We're going to talk about the rules of whether a redemption is going to be categorized as basically getting sale or exchange treatment or as a Section 301 distribution. We'll talk about that in the next video. But I just want to finish the thought on when we think about where an individual would prefer sale or exchange treatment, but let's pretend that you are not an individual. Let's say you are another corporation, right? So you are another corporation that owns stock in Bookface. Now, you actually would probably prefer to be getting where you actually is categorized as a dividend, right? So a corporation is going to want a dividend. Why? Because a corporation can get what we talked about before. Remember the dividend received deduction. Corporations are eligible for a dividend received deduction, so it might be able to get a deduction for a lot of that dividend. So just generally speaking, individuals are going to prefer if they can get some kind of sale or exchange treatment, and a corporation would rather, if they get the choice, they probably, generally speaking, would want dividend received deduction. But this difference here of whether it's a sale or exchange or it's just the redemption is categorized as a dividend, we're going to talk more about now in the next video with the Section 302B rules.